Excellent. So thank you very much for joining everybody. This is a presentation. My friend Sharu will be doing most of the presenting, but I will be here. What we're going to do is he'll go through his presentations. Always, if you have any questions, just put them into the chat and we'll answer the questions that come into the chat, and then we'll open it up to where you can unmute yourself and we can have a dialogue and get your questions answered. As I mentioned earlier today, I actually went by the property this morning. Very impressive property. I took a little video and some photos, so I'm very excited. So without further ado, I'm going to introduce the first slide, and then we're going to leave the rest to my good friend. And just to make sure that everybody understands, this Sharu is part of the Massive Masters, part of our program. He's one of our star students, just to make him blush a little bit. He's amazing. I'm going to let him tell a little bit about himself. But what's happening now through the Candace Major is, as we're looking at deals, we're bringing them to this group as passive investors of deals that we've looked at. So if you want to go ahead and share your screen.
Yes, right. Trevor. Let me go in PowerPoint mode.
Excellent. Very good. Thank you. So I'm going to do this disclaimer as the leader of the Candace Major group. So Candace Major Incubator, called Candace Major, facilitates cooperation between members by assisting in setting up presentation sessions for members with investment opportunities and inviting other members to present these sessions. Candace Major does not endorse or vet any investment opportunities that are presented by its members, and is not responsible for the investment opportunities not performing as presented. All members are advised to carry out their own due diligence on investment opportunities prior to making any investment decisions. So that's my intro. I'm going to turn it over. As I said, we'll have plenty of time for Q&A at the end of this presentation.
Wonderful. Thank you so much, Trevor. Good evening, everyone. I'm Chirayu Vail, CEO and Managing Partner for Zenvista Capital, and I'd like to thank each and every one of you who have joined tonight. We'll have a chance to walk through this high-performing, stabilized, and value-add opportunity, Vail Apartments, in the growing Houston MSA. So, like everyone knows, we are operating under 506C offering, open to accredited investors, and I'm personally thrilled to be leading this alongside a trusted, experienced sponsor team. So with that disclaimer, of course, I won't read the whole of it, but nothing shared here should be construed as a legal, accounting, or tax advice. And this is just for informational purposes only. The actual investment is triggered when you sign the official documents / subscription agreements and PPM. And we take investor transparency very seriously. And you'll see this throughout the presentation that everything is fully SEC compliant, structured for security, and positioned for solid returns. Without further ado, we move to the sponsorship team. So essentially, two partners, Zenvista Capital and Massive Capital, are the lead GPs. So Zenvista Capital is a lead GP playing the following GP roles. Finding this was an off-market opportunity. I had a connect with a broker. One thing led to the other, and here we are with this property, even if before it went for a formal listing. So finding an acquisition, I took care of large part of capital raising jointly on the loan with Massive Capital, major asset management, and expectation of a profitable exit for all of us. Massive Capital came in jointly on the loan as my balance sheet partners, helping me with part capital raising and also supervising and helping me through the asset management of this property. So those are the key roles Zenvista and Massive are playing. You will have a copy of the recording along with the PDF file of this presentation, so feel free to go through it. As we get to the property, The way I want to structure is, I expect a decent amount of Q&A from all of us, all of you. So I want to keep it to 30-35 minutes. That way I have enough time to look at questions and adequately answer them. So, from a summary point of view, we are talking about Vail apartment. It's a 60-unit apartment complex, and as you can see, each these are fourplexes or quadplexes. So we have 15 quadplexes sitting on their own lot, with a 16 feet easement behind, 10 feet on the sides, and 26 feet in the front. So each land consists of one fourplexes, and we have 15 such landlords. So 15 times 4 is 60 units. All 60 units are 900 square feet, two bed, one bath, perfect for growing families. This is a very well maintained property, and Trevor can attest to it, as well as when we went through a property condition assessment and due diligence with Freddie Mac, they felt the same. This is in a town called Sealy, Texas. As Houston, as you know, is the fourth most populous MSA. As Houston is growing, so are the submarkets. And Sealy is a prime beneficiary. 85% of our tenants living in our multifamily and other four multifamilies in Sealy are commuters to KT and Houston. So the large warehouse corridor, oil and gas corridors, where we have a bunch of jobs, people stay in Sealy for a good city, less crime, good school district, and a strong Class B market. But they save a decent amount of money on rent by living just 8 or 10 exits away. So that's Will apartment for you. 1982 build, significantly renovated in 21 to 24. 21 is when the current seller bought the property, and he did a lot of upgrades. Purchase price 5.9, but all in project is 6.5, because in addition to purchase price, we'll add acquisition fee, closing reserves, capex, etc. With that said, equity that we are raising is 2.4. We are already 1.7 in, committed and funded. And projected returns, we'll have a chance to look at what are the two different classes and each return amongst both of the classes. That said, we got this property at 98,000 and change for a door, and just the next door property is under contract for 545, which is 136 a door. So I think we got a great price for it. Just by way of other data coming through in Sealy, further evidences the fact. So that said, market and location wise, people in Texas or familiar to the area, we have I-10 that crisscrosses Florida to California. It also crisscrosses Houston. So this property is 1.2 miles off I-10, and I-10 connects to major employment hubs in KT and Houston. We have a Tesla mega factory for battery storage unit coming up with first tranche of 850 jobs, just six exits away. Plus, most of the commuter traffic is warehouse and oil and gas corridors. Now, because we have a commuter traffic, the median income is way higher. It's almost 70K. So affordability is higher. And as we go through this discussion, you will see that we have a decent cushion to raise our rents, provide good amenities, raise our rents, and bring more value to this property. So that said, our property is 93.33% occupied. This was the average in 2024. 2025, anywhere between 91.5 to 95. We discussed most of the points here. One thing is, a large tenant that we have are commuters, and the average age is 38. So many families out there. And the way I look at it is, if we do the right things for all constituents, for our investors, for our tenants, there is a likelihood that the tenants will stay longer, do the renewals, and so on and so forth. As opposed to most counties in Houston, that's my last point for this one, is Sealy has a lower tax rate of only 1.98 or 2%. Most Houston counties like Harris County, etc., are ranging between 2.5 and 3.25. So we are benefiting out of it. Now, most of the slides I have built for Freddie Mac, and I am a big fan of using a single source of truth, and therefore I've leveraged it for our investors also. So if I had to just share three slides with the investors, this would be one of them. So the entire focus is on we are acquiring a strong Class B property with a value add potential that will allow us to take the NOI from 374 to 612 in the next 4 to 5 years. So what is value add? So the easiest way for me to explain this is put this in two pillars: interior and exterior. And the entire focus is really on the interior pillar, because we have elements which can directly be connected to increasing the revenue or optimizing expenses. So let's exhaust that first, and then we come to the exterior. So, because the focus for us is to bring as much value add as possible, we are using principles of compounding to bring it earlier on in the project so we can get benefits as we get to our target NOI. So, currently, from the interior perspective, only 57 units are rented out of 60. They have occupied one entire unit as a leasing center, and it is a fully furnished unit. They have two types of unit: classic and upgrades. Upgrade commands 175 to $200 higher rent per month. So this is a fully upgraded unit turned into a leasing center. They have not made any configuration or any changes. They just have a makeshift table there. The current property management company, if you can call them, because it's not a professional company, it's just one off person working with the seller. He comes thrice in a week, 2 to 3 hours in a 2 to 3 hours in the morning. So I'm like, is there any reason? So he said, I'm already rented 55 to 56 units. I don't see a reason to come more often. Okay. Plus, there is no walk-in as such, because people call up, fix appointments to see the model units. So that one unit is partly used. There are two model units just to differentiate between classic and upgrade, which are never rented. So my idea is we don't need so much unrented units, especially when we are turning away demand. So there is a concept of remote leasing. This property is already on remote repair. But for properties under 100 doors, there is a concept of remote leasing. We interviewed four property managers. One of them is managing the largest property in Sealy. I have a good relationship with the property manager from a past account. And they are just 0.05 miles away, which is actually just crossing the street, and that's where they are. That's the biggest property, 132 doors. And they are like, we have a dedicated leasing center designed as a leasing center, so I can increase my staff and provide remote leasing to your property. Remote repair we already have, and that way you can free up the leasing unit and put it in the market. That gives us 15,200 on current rent and reimbursement. Moving one unit out of two model unit in the market gives another 15,200. But the bigger chunk is upgrading the 29 classic units. So if we upgrade the 29 classic units, we want to upgrade it enough to capture the differential. I don't want to go crazy on upgrades, because this is a class B. We want to respect that. This cannot be and will not be class A, because we are not competing in that space. So enough upgrades to capture the rent differential will give us 60,000, almost 61,000. So 29 units times 175 times 12 months in a year gives us this number. And I've given few bullet points on what difference did we see between classic and upgrades. And if we implement those judiciously as and when the units come for renewals, we should be in a good position. So the first two items, I have given it less than 1 year. This can be accomplished in less than 1 month, actually. The 29 classic units will take time, and I've given it 1 to 1.5 years. The only reason is we have to wait for the apartments to come for renewal, and we want to. I don't want to, save some money upgrading 10 units together and not having rent for those 5 or 6 days. So we'll wait for the renewals to come. We will upgrade one after the other, or maybe two or three together, and we'll see where we go with this. The next one, or the third bullet point that I missed, is currently we have a lot many small tickets. Alarm not, carbon monoxide alarm not working, so on and so forth. So we did a detailed due diligence with a professional property management company and licensed contractors, HVAC, foundation, etc. We walked all 60 units, and we made a note of all these minor items in the 31 upgraded units. We have allocated $500 per unit, which is a good number, and we will proactively fix all of this in order in the hope to reduce the number of tickets in the calendar year 2025 and hopefully in 2026. So number one, two, and three can be easily accomplished within a year. I would say 3 months. Number four, the 29 Classic will take 1.5 years. Everything that you see on your exterior value head is good to have. We will allocate budget only if needed to fix something which is damaging the property foundationally. So I've given some ideas in terms of what we could do, but there is no allocated budget for it. We have an idea of what it could cost, but this is purely on as needed basis. So that's the business plan for our value add property opportunity. As we move further, investment classes. So we have Class A and Class B. So let's start with Class A. So in my mind, and coming back from past experience, I always want to present an opportunity for income seekers and wealth creators. So Class A is primarily for income seekers or income generators. We get a 17% preferred year over year annual return distribution once in a year every December. No profit on upside, but all Class A members will get depreciation benefit in the K1 form. So this is essentially fixed returns year over year. We kept a minimum investment of 300K. Out of 750K, we already have 650 committed and funded. So now we have just 100K. So the minimum does not hold any value. We have 100K, and that's the number that we are looking to fill basically. And coming to Class B, we have minimum of 100K. And Class B is 7% preferred return, but a huge upside on profit, which takes your average annualized revenue to 26%. There is a slide where I explain how I come to 26%. So huge profit from upside, smaller preferred return ticket, and equivalent depreciation. I'm not differentiating between Class A and Class B for depreciation. A dollar in Class A or a dollar in Class B gets the same depreciation. So that's where we are. Out of 1.65 million, we already have a commitment of close to a million. So 700K is the remaining raise. In terms of distribution order, of course, when we get all the income minus expenses, we will first service the debt, which is the first lien mortgage of Freddie Mac, accounting and asset management charges, and then the remaining proceeds goes first to paying Class A. So in the distribution order, A gets paid first before Class B. Currently, we are accepting all funds, personal funds, investment transfers, and SDIRA funds. So if you have an IRA account, we have a way to introduce you to IRA servicers who will create this self-directed IRA account and allow you to fund this opportunity. All profit from sale, returns, yearly returns, etc., will go back to your IRA account. And we have a way to do that. I also was entertaining 1031 exchanges, but given the time that we have, we are not having any 1031 conversations. It's a question of timing. 1031 has to really be right on time. A sale of property is there, you have money already funded, and you are in that 45-day period to identify your next investment. So currently, because we are so close to closing this opportunity successfully, a 1031 may not make sense. But personal funds, investment transfer, SDIRA, all are welcome. And again, 100K remaining for Class A, 700 for Class B. Now, to put it as simple as possible, I just created one slide each for Class A by saying this is what you invest in the first year. I give you 17% each year and return your member capital in year five, which gives you 1.85 equity multiple or 17% annualized return. I've also given an idea of how much depreciation would you get. So we work with medicine specs who are our experts, cost segregation experts. They have actually taken data from the county or available data and come up with this number. That this is a good number to share for 2025 bonus depreciation, and 87K is for year 2, 3, 4, 5 total. Same example for Class B, I've taken 100,000 as minimum, but as you can see, there is a line profit from sale that comes at 95,000. That takes your equity multiple to 2.3 or average annualized return to 26%. So to put it simply, a big return due to profit from sale and same depreciation. 19K for the first year, 29K as a summer, a total for the next 4 years. This is assuming a 5-year holding period. Big question. So this would be out of the 3 top slides. This would be the second slide. Exit strategy. So Freddie Mac is like, I'm convinced I need to know what your exit strategy is. Try to put it as much in numbers as possible. So here is the roadmap for exit strategy. So number one, what is my trigger to sale? And I'm focusing on number one on this slide. The trigger to sale is when my NOI is closer to 600K. That's the time I will softly and more attentively start looking at micro and macroeconomic situations that can positively impact the sale of this property. So NOI at 600K is key. Now, for any valuation, the simple mathematical equation is NOI divided by cap rate. In number two, just like for every stocks that we have in the equity markets, we look at Morningstar and Bloomberg for data analysis and data. We look for commercial real estate, as you all know. CoStar is one of the sources we look at in terms of cap rate and many other projections. So cap rate is not in my hands. Cap rate is something that is dictated more macroeconomically. So in CoStar for Greater Houston markets and submarkets, the projection for the next 5 years ending in 2030 is 6 to 6.25. If you see the graph is close to 6%, but I'm just saying 6 to 6.25. So your NOI 600K divided by 6% will give you a sale price of 10.2. So here I'm expecting an NOI of 612 divided by 6% cap rate, highlighted areas, gives me 10.2. This 10.2 valuation is enough for me to pay that profit from sale and get your average annualized revenue for Class B to 26%. So Freddie Mac said, convince, give me some sensitivity. So then I gave sensitivity on both the levers, NOI and cap rate, where if I cannot achieve 612, I'm 5% off or I'm 5% plus. I cannot get 6%, I'm higher or lower. So let's see the lowest point. Lowest point is lower NOI and higher cap rate. That's 9.3 million. Or best case scenario, lower cap rate and higher NOI. So based on low and high, the annual average annualized revenue comes to 23.1 and 28.4 for Class B. Nothing changes for Class A because they are fixed returns. So this is an idea of where we want to land, possibly higher than that, and the other possibilities based on NOI and cap rate changes. So that said, the next steps would be, so before next steps, everything that I'm doing here in terms of bringing investments for Vail Apartments is through Cash Flow Portal. Cash Flow Portal is a fully digitized syndication software, intuitive, streamlined, fully SEC compliant, with 3 layers of security. I don't want anything of this to come to my personal portal or anything. So we are almost paying 3.5, 4,000 subscription per year. Money well spent, because all the investors and the GPs, that is myself, we can have a peaceful sleep knowing that everything is in a secured place. So the easiest way to invest is click this link or scan this, and it will give you a login page where you have to sign up and follow the process of investing and reviewing and e-signing the offering documents. This would take maximum 7 to 10 minutes of your time. Once you complete this 1 and 2, the expectation is, because we are right at the time of closing, so expectation is, if you can identify that this is the property I want to invest in, um, more than welcome. Complete the signing process by May 11th and funding as soon as possible. If you are in a SDIRA situation, let me know. I'm more than happy to help you there. Once the signing is complete, you don't have to necessarily wait. Next is, the system will generate a funding instructions email to you, which has all the details of wire transfer. And you wire transfer the fund, and the system will notify that the money has been received. Simple 1, 2, 3 steps. And once you establish yourself on the portal, you have a way to log in, log out with two-factor authentication, and look at everything that you have signed, all the K1 documents, preferred returns, everything in the future, all the communications from me in terms of the progress, quarterly, 6 monthly, yearly, everything will be in your specific vault. So you don't have to go helter skelter looking for emails. Just log into Cashflow portal, you will find everything there. And that way it is much easier to scale as we go further. If you need any assistance, you have my number and email. I'm more than happy to get on a quick call and take things further. From this point onward, just few appendix items. I'll just take 5 minutes to go through. There are some which are mandatory, which I'm supposed to tell you, some which I would love to tell you. First is underwriting. So everybody who's focused on how do you get to 374, which is my first column right here, to 612. So everybody would like to know what that story is. That story is essentially taking NOI from 374 to 612. Easiest way for me to summarize this, and this is a extract from synthesis, that's a tool we use. Easiest way for me to summarize is putting these boxes 1, 2, 3, and 4. And I'll quickly cover it. One is focused on higher income. We discussed that putting one model unit, one leasing center, upgrading 29 units will get me higher income in year one. Not so much, it is just a 33,000 bump, but a decent bump, 65,000 in year two, because all this 29 refresh units will start hitting the market. And having said that, number two, not everything is green, because the replacement cost of this property is changing. I will end up paying higher real estate taxes. So we got a note from our prospective tax expert who files protests for taxes. This seller, by default, every year he files protests for taxes. So I spoke to that tax attorney, and he said, you will never hit 96,000. At the max, you will be close to 80, 84. So we got hold of CMI, who's our tax expert. He exactly agreed to that you'll be around 84, 88 at the max. It never happens that they proportionately charge you higher taxes just because the value is higher. But I have taken 96,000 as if they are going to look at the value and charge me that way. So there is some savings coming out there. But conservatively, I've kept a higher. Insurance goes up from 51 to 56, 10% is expected because replacement value changes. So other than that, our tenants are paying almost $1,200 water bill, which I feel is pretty high for a 900 square feet. $100 per month is a very high bill. We have kept a $15,000 budget for water conservation program, changing faucets, low flow toilets, all that good stuff, which is $500 a unit. This will significantly lower their water bill. I don't need to do this because I'm going to charge them for water, which typically happens. But this is a gesture from us to the tenants that will spend the money to make life better for you also. So that savings we will see in year two with slight increase in year. This is the inflation adjusted increase. If we do everything right in 1, 2, and 3, we will end up having a higher NOI. And if you can see, we are going aggressive the first 2 years to get to a decent point at the end of year two itself. From that point, I'm showing a progression to reach 612. 612 could come earlier in year five, or if everything goes well, then end of year four. I just wanted to show that progression. What do we get as GPs besides 70-30 split? We get 2% acquisition fee. We get 3% asset management fee, 3% on income, 2% on purchase price, and 2% at exit capital transaction fee at the time of exit. I've color coded refi because I don't see a situation where we will be able to refi in year 2 or 3 and net out all expenses to refi and 3 years of prepay penalty from Freddie Mac and still come to a position where we have excess cash to proceeds to distribute. I don't think we'll be in a situation, but in any case, I highlighted. In case if this refinance happens, whatever proceeds we get will be split to Class B investors first, because as per SEC, Class B investors are higher risk takers. So they get a proportionate of their equity capital back if refi happens. That was it. Anybody who's interested to know sources and uses of fund, uses is the total purchase price plus acquisition, closing, capex, and reserves. So total project cost is 6.56. We are getting 4.2-ish funding from Freddie Mac. Exact numbers will be out in a week, and the remaining we are raising. I wanted to show a comparable of where we are. Out of the 5 apartment homes, we are number 4. Not a good student in the class, but that's the case for value add. If you see the last column, average dollar per square footage, I have ranked them, and Vail Apartments is rank 4, very close to Harvest Moon, which is rank 5. Everybody else is higher dollar per square footage. And for us, FYI, to get to 10.2 million valuation, aka 26% average annualized rent, our target average price per square foot is 1.48. If we get to 1.48, we are in a good position, and we have 5 years to get there. So I think we are in a good position. We don't have any aggressive targets to meet, on and so forth. We did a detailed due diligence, spent close to $10,000 with a professional property management company and 4 licensed experts. Everything we consolidated in one slide. Freddie Mac is like, we have quite a bit of data you shared. Can you put that in one slide? So I put 3 pillars. You can go through it, put everything in one slide. The math out of this equation is for all the good to have, for everything that the license contractors do, they have a tendency to say, oh, you got to fix this, world is coming to an end. So he said, okay, I got this. Why don't you differentiate between what is deferred maintenance which needs to be fixed now, what is good to have recommendations? So when we did that, we went through the discussion and we have made sure that our capex and reserves is adequate enough for us to weather the storm, have enough liquidity, and complete all the minor points that have come as part of due diligence, and have enough money for capex and reserves. Through this exercise, we identified that there were 5 AC units which are close to the end of the year period. So I just had a conversation with the seller. What would you have done if you were not selling this property? He said, you're right, Chirayu. Let me reimburse that money to you. So we have $40,000 coming in at the time of close. So we have 342,000 as working capital reserves, rehab money plus 40,000, 382,000, which is adequate. Risk factors and mitigation, one slide that says it all. The interesting part is the Freddie Mac loan is a fixed 10-year loan at 6.45%, 30-year amortized, first 3 years interest only. So interest rate fluctuation doesn't matter to us because our holding period is 5 years, maximum 6 years, and we should be in a good position. Sustainable rents, there is a good bit of distance between A, B, and C properties. What we want to be is the best of B, so we have enough cushion to go there. Prolonged downturn, the residents are already in a good spot from an income perspective. If there is a prolonged downturn, I expect the A's to kind of sort of adjust their lifestyle and come to B's. That will benefit us. Liquidity wise, we are supposed to raise 7.5% of total raise as liquidity. We are close to 10%. So checking that box. Plus, we are keeping 15,000 replacement reserves every year. Expense control, current property management company is doing an okay job, but we have quite a few ways to tighten and optimize expenses. Plus, remote leasing will get us 15,000 more from that unit. This could not end without thanking all the partners here, from our syndication and real estate attorney to tax protest person to Oakleaf Management, who's going to be our proposed property management company, to Medicine Specs, who's our cost segregation expert, who does the depreciation calculation, and then Seth and Alexander as a CPA, as a syndicator account. So that's it from my side. I will keep it at this. And
we do have one question in the chat. The assumption is that you're going to upgrade the classic units only when there's a renewal and a confirmed lease upgrade.
Yes. And all the leases that we have currently are either 12 or 13 months. So there is an expectation that in this cycle, the apartments will come for renewal.
Excellent. And then do you know what year Tesla factory is estimated to be built?
Tesla factory, ABC News mentioned it's coming up. The first tranche of 850 jobs is coming up in January of 2027, which is almost a year and a half from now. But by passing through that, we have seen that they have completed land entitlements and they have cordoned off the area. So in terms of construction, they are moving at Tesla speed. First tranche of job is 850, followed by 1750, but 850 by January of 2027.
It's awesome.
And that is just 6 exits from where we are.
Very good. And a couple of things I want to make sure that the folks here understood the importance, especially in the today's world, of fixed rate debt. This is super important. And again, being able to get this funded through Fannie Mae. It's Fannie Mae, not Freddie Mac, right? Or is it
Freddie Mac? Freddie Mac.
Freddie. And to be able to get them to do it, to be able to have a fixed rate at that level, and to have 3 years interest only, I want to make sure that the audience understands that lenders look at the financial viability of a project before they go ahead and do things like that. Give it the interest only. And the distinguishing between classic and premium, what is the difference between the two?
Is that a question?
Yes.
Yeah, let me get to that. So classic versus premium, the key differences in the premium or the upgraded, they have vinyl plank floors. They have upgrades in the toilet, low flow toilets, faucets, brand new shower heads. The color scheme in classic versus upgrade is different. In the upgraded ones, they have a two-tone color scheme. In classic, the color scheme is the acceptable gray or the standard gray color. Appliances are better in the upgraded units. Few have stainless steel appliances, but most of the upgraded have black appliances. And in the upgraded units, they have, in some places, they have granite countertops. So they have upgraded Korean and or granite countertops in the upgraded units. So mostly that we have also seen a new set of light fixtures in the bedroom as well as in the kitchen and the main room, the living room. Those light fixtures are slightly better quality than the classic ones. These are the key things that we have seen there.
Excellent. Any other questions from the group? Feel free to type them, unmute yourself. You did such a good job. Very good. Thank you so
Thank you.
much. Yeah,
No, thank you. Thank you, everyone. And feel free to ask any questions. You have my details here. You can contact me, scan this code, look at what details are there on the cash flow portal website, so on and so forth.
excellent. And then we're going to send out a recording, so it will come out. So folks that have registered, we'll get your email and we'll make sure that we send you a copy of the deck and the recording.
Sorry,
Any
Chair,
other Yeah,
sorry, Manish. Just one last question. I saw that we're expecting rent increases. Have we done any market sensitivity analysis of the rent increase which we are expecting? What's the probability of that rent increase?
Yeah. So we have done a study where what is the average rent capture for each class, class A, B, and C, and we are right front and center in B. So even within class B, we have out of five, three properties are in class B, and our rent is 1073 plus from some reimbursement. That is the lowest point of rent. We have rents in class B of similar unit size of 1250.
Oh,
So we have done this study, and even 1250 is non-upgraded unit, and our upgrade we are selling at 1125 or something. So there is a decent gap out there that needs to be achieved. So what we are going to do is we just cannot go aggressive from day one. So the way we are going to structure this is all the upgrade units will go through an inflation adjusted increase of 4%. Even they have not done this in the last 2 years. 4% is a standard increase. And as and when the renewals come, we will upgrade that units, and that will start fetching $175 to $200 differential every month. So we are doing a two-pronged strategy on classic versus upgrade, if that helps answer your question.
understood. Thank you, Trevor.
excellent. Any other questions? Well, we really appreciate this. And again, if you have any questions, please let us know. We really appreciate you spending your Tuesday evening with us. And if you thought this was exciting, make sure you invite another big dog friend to come Monday at or Thursday at 1. We're doing this presentation again. Oh, one other question.
Yeah.
Amenities on the property such as pool.
Yeah, so we don't have any such amenities. The only amenity that we have is we each of the property has washer dryer hookups. So the tenant has a choice to bring their own washer dryers, and if we provide, we charge $60. Other than that, the property which is adjoining the 0.01 miles property, which I'm saying that the property management is managing us, so their amenities are not used as much. So we are trying to tie up with that company by saying that would you allow, can we put something like an access card where you will allow our tenants to use your swimming pool and the large room facility at $30 or $35 a month, whatever that affordable number is, and they are happy to entertain this conversation. So amenities per se, we are going to have we have washer dryer connections. We will have a dog walking area, but now we are tying up with the other larger property to use their amenities at a cost. So that's some way of getting more revenue for us. That helps.
Yeah. And then just quickly, as I mentioned, I went and visited today. And so picture's worth 1,000 words. So
Yeah.
you can see how this is a fourplex, a fourplex. Each one has their own parking up front. They have access for the units above. So again, this is looking across. It was garbage day, so there was a lot of garbage cans, but you can see well-maintained, nice roofs, not flat roofs. Very treed. I did a video and the birds were chirping like crazy. So again, this gives you an idea. And then there is a fence between each one. So the units themselves are really nice. And then one of the things that was brought up is this one is now being used as a leasing office, which is an absolute shame because it should be paying rent. So,
Yep. And 8 parking lots per unit, per building. So 2 per unit, which is unheard of, which is really good. So, and beautiful lots, mature trees. When you see there, you feel that warmth.
Yeah. Excellent. Very
Great.
good. Well, thank you, everybody. And you have a good evening. Talk to you all soon. Take care. Thank you.
Thank you for your time. Thank you, Trevor.
All right.
Appreciate
Bye-bye.
everything. Thank you. Bye-bye.